All right, welcome everybody. Let me make sure we're, I guess, first question is, can you hear us or me? Raise your hand. Hands went up. Can you see us? Is all that looking good? Can everybody see us? Yeah, people are raising their hands. So for some reason, and I guess we don't, if you don't need to be a presenter this time because you don't have a handout that you're going over.
Oh, I've got a presentation though.
Oh, okay.
And then I can email it to you after.
Sure. Okay, let's do that. So let me make you a presenter.
Okay.
If anybody would like a copy of the presentation, you need to send me $5 and I'll put it in my Stripe account for you guys. But anyhow, we'll send it to you afterwards. And so welcome everybody. Are you all set up to present, Jody?
I'm ready. Yeah, I clicked the presentation once you tell me to start.
I'll do that. Okay. All right. Well, welcome everybody. I'd like to introduce Jody Hatano. For those of you that haven't met her before, she's with Golden One Credit Union. She's the loan agent that I would use if I were using a loan agent right now. I would refer everyone I have to Jody, and you might want to, I'll text her contact information in case you have somebody that you would like to get pre-approved for a loan and work with a really good loan agent. And I'm going to let her take it from here because that's why you came, was to hear her and not me.
Thanks, Mike. Let me start out by, I'll go ahead and share my screen here, and then let me know if there's any issue with you seeing it.
We can see it.
You can see it?
Yes.
Okay. All right, perfect. Okay, hi everybody. Looks like we got about 30 on this call, so just want to say thank you so much for taking time to set aside and talk. Let's have a conversation about what the process is really like for on the mortgage side of a real estate transaction. This is really kind of the heartbeat of the transaction once you have a contract, and my experience tells me that it's probably a good thing for us to have conversations about what it really is, what it's like to go through the process. I know you guys as real estate agents, you don't see everything that we see on the loan side, but this is the time where things can kind of go sideways, and I'm going to give you guys a little bit of inside information, kind of deep dive into some of the potential issues that could come up and how to resolve them. And if anyone has any question, just go ahead and write it down, and then at the end we'll do a Q&A, and I'll stay on for however long you guys have questions. If you want to run a scenario by me, something like that, feel free. So you'll see my, oh, not here, on the end of the screen, end of the show, slideshow, there will be my phone number and my email address. So you can take that down and call me with any issues. And that's the wrong slide, so my apologies. Let me get the right one here. I've done mortgage rate shopping on other calls, and if you guys are interested in that, then we can do that next time. But this is the wrong one. My apologies. One second, Mike. Okay. There it is. Oh, it keeps popping. Okay, here we go. Okay, we start at the top. All right, here we go. All right, welcome. Loan process from contract to close, how it really happens. There's my phone number and email address in case you guys want to take that down. So we'll just jump right in. And I want this to be kind of a conversation. So again, if you have any questions, we'll get to that at the very end. Okay, so two different kind of ways that this works. You may refer me a client of yours before you have a contract. Typically, that's what happens. And so this is the process I'm going to work with your clients through before contract. If you end up with a buyer with a contract that has no lender, then we're going to go through the same process. It might be a little bit more stressful because we've got a time frame here. 21 days, 30 days, however long it is. So I encourage you to make sure that your buyers are well qualified before you start going into contract and shopping, making offers and that kind of thing. As you all know, it is an insanely competitive market out there right now, to the likes that I've never seen before. I sent Mike an article a couple of days ago about a home in Berkeley that sold for $1 million over list price. $1 million. I mean, I've seen 100,000, 200, but $1 million. So I can't remember how many offers it had, but then he shared back, property that had 120 offers, 70 offers. So to make your case as strong as possible, we need to make sure we go through this process up front. That way you can go into it with no finance contingency, appraisal contingency, that's really going to be between you and the buyer and what you think that the property is going to come in at. Go ahead and prepare them if it's going to come in a little lower, if you think that, or if they've overbid a little bit, but they want it anyway. But the rest of the process that we're going to talk about right now, we're going to uncover, during that time, we're going to uncover any potential challenges that may arise pending, and there also could be something that comes up during the actual process, and I'll talk about what kind of scenarios, I'm talking about with that. So I've got a new client and we're having our first conversation. This is what I'm going to talk with them about. We're going to start with the income documents, okay? Income, credit, assets. Those are the big three pieces of this whole transaction for the lender side. And one doesn't outweigh the other. So, for example, if you've got a 620 credit score and a 10% debt to income ratio, it doesn't matter. You still have to have a 680, that's our minimum credit score, or 640, depending on the loan type. If you've got 2 years of reserves, but your debt to income ratio is 54%, those two things don't work together like that. So each individual section has to be meet guidelines on its own. And I'm telling you that because I've had that question a couple of times here this last week, and I just wanted to clarify. So for income, typically someone that's receiving a W-2, it's going to be a little bit easier of a transaction, simpler, I should say. We're going to ask for the most recent pay stubs covering 30 days, and they have to be consecutive. So, March 1st to March 31st, I'm going to want those pay stubs, or March 15th to April 15th, depending on, what time of the month that I begin this process with someone. W-2s for the last 2 years, that's pretty simple, straightforward. Sometimes you'll have income such as child support, alimony, or separate maintenance that we're going to use. In that case, we have to get the divorce decree. People don't like that. They feel like it's invasive, and I can totally get how that feels that way. But keep in mind that as far as the lender goes and I go, we're not reading every page of it. We don't have time to, and it's irrelevant to us. What we're looking for is the court order for this income to be paid to the borrower. And then we're going to need a bank statement showing that they have received it, so at least one time. Other than that, we don't really care what's in the divorce decree. If the person has a separate court order, then sometimes we can get away from having the divorce decree. It just depends on, each situation. So again, someone who's not self-employed just receives a straight W-2. Maybe they've got overtime, bonus, or commission. Typically, it's just going to be W-2s, no tax returns. If the person is self-employed fully, or their 25% or more income comes from bonus, overtime, or commission, or self-employment. For example, they may have a K1 that's 26% owner. You got to have business returns. So these are all the things that I deep dive into with a borrower at the very beginning stages. So I've listed here what to expect that's requested for self-employed borrowers. And I want to stress the 2 years filed tax returns, because it got us in one transaction a couple weeks ago, and also talked with a listing agent yesterday, and she had lost a closing for a guy who hadn't filed his tax returns, and there was some tax liens. So these are the kind of similar situations. So it's very important self-employed borrowers, or the other scenarios, 25% or more bonus, overtime, or commission, the tax returns that you turn into the lender have to be filed and processed by the IRS. We will and reserve the right to always execute what's called the 4506T. That's a tax IRS form that we're requesting the transcripts. So what we'll do is they'll hand us the 2 years tax returns, and then we will go to the IRS and say, hey, and it's a form the borrower signs and authorizes us to do this. We need these transcripts to match up, make sure they're the same ones, okay? This happened not 2 weeks ago or so, that someone hadn't filed the 2018 returns, but we had the 19s, and we ended up not being able to close because the 2018s weren't filed and processed. So we didn't know what the true tax liability would be. This self-employed person who we knew would owe taxes based on what they had given us, even though it wasn't filed. So we weren't able to close that loan, and that happened after the appraisal. That happened, you know, unfortunately, a couple of weeks before we wanted to close. So it was, you know, it's sad and upsetting, of course, but we have to make sure that those tax returns are filed. So if I ever call you and say, hey, you know, this is an issue, know upfront, returns for self-employed, bonus, overtime, or commission, we have to have them filed. I'm stressing that because it has come up here in the last 2 weeks, and I want to make sure you guys completely and solidly understand that part. Okay, so assuming that's the case and we have the filed tax returns, we're going to also need the 1099s. So for example, if someone's retired and they get 1099 retirement income or Social Security, that kind of stuff, then we'll get the 1099s for that. And then we can match that income up with the tax returns. For self-employed borrowers, or again, 25% or more income from those other three sources, we potentially might need the business returns. Now, if you file S Corp, then we might need K1s. If it's just you file your business income on your personal tax returns, no big deal, we just go with that, okay? Typically, we're going to ask for a year-to-date profit and loss statement in lieu of pay stubs. You know, self-employed borrowers, sometimes they pay themselves with a W-2. It's usually pretty minor income. It's not their significant income from the business. And we can use that income too. But we will need the federal tax returns if they're self-employed and file that way. Profit and loss statement, balance sheet. That's the form that tells us basically what assets and liabilities does the business have. You know, I will tell you that last few self-employed borrowers I've had, we haven't really had a balance sheet that's been requested, so maybe they don't need it. It just depends on the situation, the type of employment, and employment history. Until the new deadline, I believe, of May 16th, we will not request 2020 tax returns, which is kind of important right now, because if you think about what we just went through and are still going through, unfortunately, with 2020, a lot of people's income went down significantly. But for now, until those taxes are due by the IRS, we don't request the 2021s. After May 16th, if the borrower has filed an extension through October, then we just get the extension form, and then we'll deal with the 2018 and 2019 tax returns. Okay, so actually, I'm wondering, Mike, do you think it's okay? Like, can we just take a quick moment right now to see if anyone has any questions? Because what I'm going through here is a lot of information, and I want to make sure everyone understands it as, you know, we're talking about it. Do you want to kind of open it up for a couple minutes to see if anyone has any questions?
Sure. If you have a question, you can either type it in. If you raise your hand, I could unmute you. Otherwise, we generally would go through the questions at the end.
Mm-hmm.
I don't
Okay.
see.
Okay, that's fine. We can do that. I just wanted to make sure.
Type in your questions. We'll cover them at the end.
Okay, got it. Perfect. Okay. So moving on from income, asset documents required. Bank statements. This can be one of the challenging parts of the transaction, because People don't generally like to give out all their asset information. We don't require at Golden One all of the assets that a borrower has. All we are trying to confirm is that any of the money that's going into the transaction is sourced, okay, it's seasoned, and I'll talk about what that means in a moment, and it is allowed. So there are types of assets that cannot be used in a transaction. Bitcoin, don't even think about it. It's not something we can source. It's not allowed to be used, and I don't know any lender that uses Bitcoin or any kind of cryptocurrency to not get around it, but to be able to use it. I always suggest you got to cash it out, and it's got to sit in your account for 60 days. After that, it's considered seasoned, and we can use it. So if you're working with someone or just starting to work with someone and they say, oh, you know, I've got 100 grand in Bitcoin, and, you know, they may not want to sell it now, but to be able to use those funds for the transaction, they should go ahead and liquidate that into verifiable assets and let them sit for 60 days. And that's called seasoning the funds. Okay, so I'm just going to kind of read through here and briefly talk about each bullet point here. Okay. What we're doing with the bank statement, sourcing the earnest money and the down payment. Cash deposits cannot be used. So if I get a bank statement and there's, you know, $10,000 in cash deposits, there's no way to source that. It's not something that's going to be used. I've had people tell me 1,000 different reasons of where that money came from, and you know, it's commonly I lent money to a family member and they paid me back. It's not something we can use unless you let it sit there for 60 days. Okay. And so another benefit to me talking with your clients ahead of time, ahead of you going through this, you know, even starting to look at a home, is let's look at your asset situation right now and go ahead and resolve any of these potential challenges that we have with where your money's coming from. Okay, so cash deposits can't be used. Large deposits other than payroll. This does happen quite a bit. You'd be surprised how many people move money around from this savings account to this checking account, then back and forth, and it's different amounts and all of that. It's not fun, but we have to source every dollar that goes into the real estate transaction. And that means getting bank statements. Even if it's 3 months ago, we have to do it. There's no exception to it. You can't get around it. It's required by all lenders. You're not going to find a lender that's going to say, oh, this, you know, $50,000 cash deposit, no big deal, we can use it. It's just not going to happen. So, you know, any large deposits other than payroll, we have to source and explain. Let's say you have a check from, I don't know, a insurance claim. Maybe you wrecked your car or something, and you've got an insurance check for $7,000. That's fine. That's your money. You can use it, but we need a copy of the check and then a quick little explanation, you know, that what this check is. This is from, you know, an accident. We don't need details. We don't know if you got injured or anything like that. But we do have to have the borrower explain where it came from. Not that we don't believe them, but it has to be documented in the file. Most of what a lender asks for is not because we don't believe somebody or we think they're, you know, shady or anything like that. It's because a loan file these days, and it's been like this for a while now, it has to have full documentation, and we have to verify so much information. And part of that is engaging the borrower to do that and help us. Gift funds, that's a big one. We do see a lot of gift funds, and that's allowed. You'll see down in a couple more slides that we allow 100% use of gift funds on certain loans, which is different than a lot of the big banks out there who will say, well, you have to have at least 5% of your own money to go in the transaction. So we don't have that rule, but you'll see that later on. All we do with that is have a gift letter that's signed by the donor and the recipient that states these funds are not to be repaid. It's just a way to document the file that these are not borrowed funds. So you don't have, you know, a person borrowing $200,000 from their parents to buy a home, and then they have to start paying back, you know, $1,000 a month. I have actually never seen that type of agreement between people, but parents, kids, or whatever, but you never know. I always say, hey, I wake up every day, what am I going to see today? So all we do with that is just get a signed gift letter. It's something I send out. It's very simple. It doesn't have to be notarized or anything like that. and that's sent back to us, and then we've got the file properly documented with those gift funds. What I usually say in regards to gift funds is, unless the donor has already given those funds to the buyer or to the recipient, it's best just to go ahead and have those funds sent directly to title, and I'll tell you why. Because if the donor puts the money into the borrower's account, say a week before closing, which happens, I've got to have new bank statements now. I need an updated transaction history to show the money has posted, not pending, but posted to the account, okay? What could go wrong with me asking for an updated transaction history? Well, number one, the borrower gets upset, but there's no way around that. Number two, if there's any large deposits between the last statement I have and this, the donor funds, we're gonna have to source that. If you've got even potentially undisclosed debt, say this person's credit profile does not show any credit card payment, or I'm sorry, any credit card accounts, but their bank statement shows Discover payment, American Express payment. What is that? Usually the spouses, if they have one, but we need to know, do you have these two accounts open that we don't know about? It's not that we think you're doing anything wrong, but we can't have any undisclosed debt in the transaction. So then I'm starting to ask for more documentation, then people kind of get their feathers ruffled a little bit. So it's just best for the donor funds, keep them in their account, have that money sent to title. It makes it a lot smoother. In regards to documents, assets, verifying everything, screenshots do not work. I can't tell you how many times I get this, but I do get it quite a bit, where someone will even screenshot on their iPhone or cell phone, whatever, and email me a screenshot that it has no name, no account number. Sometimes I can tell what institution it is just based on my experience, but that doesn't work for us. We have to be able to match up the borrower with the assets, okay? You could screenshot anybody's account, Bill Gates' account to me. Well, probably can't do that, but anyway, so it's very important. No screenshots. We have to have assets that show identifying information. So the name, account number, and running balances. Okay, that sometimes can get you too, because transaction histories don't always have a running balance. So it may be that the borrower has to go to their main financial institution and get a transaction history. Inconvenient? Yes. Is it required? Yes. Is there a way around it? Absolutely not. So something to keep in mind up front. I think I just already mentioned about the earnest money posting. For assets, for Golden One, this is something that I really like about working here, is that we only require 2 months of reserves. I come from big banks, and there, you know, Chase was the last place I worked, 6 months, 8 months, 19 months, 24 months. It depends on the loan program, but I've seen that, and there has been transactions that we weren't able to close because the person didn't have post-closing reserves sufficient to meet the guidelines. So here at Golden One, only 2 months reserves required, okay? So if you've got anybody sitting out there that is kind of real tight on that, on their assets, give me a call and we can talk about the scenario, and maybe it's something I can help with. Assets in retirement accounts, we can actually use those for reserves and for down payment. If the person wants to utilize their 401k for that, that's fine. Again, documentation is going to be required. We're going to get their terms of withdrawal that says they can use this money. One of the nice things about here is that, let's say that someone takes out $50,000 from their 401k and they're paying back out of their paycheck $400 a month. We're actually not going to count that against them in their debt-to-income ratio. Because what they're doing is paying themselves back assets. So we don't look at that as a liability. It's not a credit account, okay? All right. Credit report. Okay, so we've talked about income, assets, now credit. Each lender has to pull their own credit report. I have had numerous occasions where a borrower emails me their credit report, and that's fine. I'm happy to look at it. If they want me to take a peek at it before I pull to make sure everything looks good, I will do that, no problem. But that report cannot be used for the transaction. We will pull our own tri-merge report with all 3 bureaus. The middle score is what's used to base the loan off qualification and pricing for the interest rate. So if you've got a 680, 710, and a 740, we're not going to use the high. We're not going to use the low. We're going to use the 710. That's your qualifying score, okay? There used to be, back in the day, lenders could do what's called a rapid rescore. You know, maybe somebody needs to pay their debt down to increase the score a little bit, and then we could rescore them, but that's not allowed anymore. So another reason that it's great for me to take a look at this, all of this stuff up front, we can go ahead and counteract any issues that we could potentially face. Potential letters of explanation needed. This is very common. So if you hear of this from a different lender that they need this, don't be surprised. I think probably 90% of my loan applications need at least one of these, if not both. Any inquiries from the last 120 days have to be explained. I've got kind of an example. And all this is just to make sure that there's no undisclosed debt on the application. For example, you know, we're not closing a loan where someone has $1,000 a month payment to some credit account that we don't know about. They end up defaulting, and then guess who gets in trouble for closing that loan, putting the borrower in potential financial distress? The lender. So we have to make sure that we're closing loans and putting people in a position to be financially successful. And we are going to be digging deep into their lives for, you know, 21 to 30 days, or maybe longer if I'm working with them for a while. But it's all to make sure that we're doing the right thing. So an example of a credit inquiry would be, I, Jody Otano, did not open any credit accounts as a result of these inquiries. And then I will also give them the inquiry so they don't have to guess or anything like that. Or if they did open something, maybe they bought a truck 2 weeks ago. That's fine. We just have to have an updated statement so that we can include that in your debt to income ratio, making sure, again, that we're lending responsibly. This is something that happens, I would say, probably 95% of the time. Real estate addresses showing up on the credit report. So, you know, anytime you have your credit pulled, whatever address you put in for that creditor, when they run your credit, boom, it's going to go on your credit report. So let's say you moved out of state and you were staying with your family for 6 months, you applied for a mortgage, that address is going to show up on your credit report as potential ownership. So we look at that and say, okay, how do we combat this? Letter of explanation from the borrower stating that they either do or don't have potential ownership in a particular address. A lot of times it's going to be an apartment, maybe a current apartment where someone lives that's, you know, with an actual, you know, apartment complex. We know, we can Google the address and know that the borrower doesn't own it, but we still have to have a statement from them saying it does, or saying that they don't. If they do have ownership interest in a property that we don't know about, maybe they're on the deed to their parents' property, but they're not financially responsible. That's still ownership, and that's fine. We just have to potentially get some more documentation. The mortgage statement, if there's a mortgage, to confirm they're not on it. Home insurance, if they're financially responsible, home insurance, the tax bill, making sure again that we're putting that in to their debt to income ratio correctly. Most of the time they don't have any ownership. People are pretty good about knowing that and putting that on the application up front, okay? Please don't, and help me stress this to borrowers, have their credit pulled during the initial time I pull it to closing. We will pull a gap report a few days before closing to ensure that during this process, they haven't filed bankruptcy, they haven't gotten collections or judgments, or God forbid, federal tax liens pop up there. So we will pull a gap report. It's not a full hard inquiry, it's a soft inquiry. So we do that, and if they have opened up a new account or had inquiries between the time I pull it and the gap report, I'm gonna have more documentation. I'm gonna have to have them state if they did or didn't open an account with this institution, or if they did, then we have to have the statement, you know, showing what the balance is and what the monthly payment is. So it's just best, I know you wanna go shop and buy some furniture, but let's not do it yet, okay? Let's get those keys in hand first. and then it'll be a lot more exciting and no stress after that. All right. This is because I'm going to email this over to Mike, and then you guys can use this for whatever you need. This is a great resource, this slide right here. If you're talking with someone who knows their credit's not up to par, they can go to My FICO. It's the address for it is just down at the bottom, myfico.com, and they can get their own credit report if they want. They can review that. They can get all 3 bureau report if they want. I think you do have to pay for it on myfico.com, but it is a great resource. I personally use it. There are different scoring models that the bureaus use to provide a score to a lender. So for example, Credit Karma, that's a great resource. I love it. I use it. But it's really for educational purposes, okay? Your Credit Karma score might be 770, but that's definitely not going to be the score that I pull. It's not going to be the score that an auto loan company would pull. Maybe you apply for a credit card. They're not going to pull that same score. So there's different models that are used, and it's all about assessing risk for that type of credit. Okay, most of the time you've got a higher auto score than you do mortgage score. Mortgage scores are usually the toughest one because you know a lot more risk. Credit card score is usually a little bit higher than your mortgage score. So myfico.com, you can actually, if you pay for it, you can get those actual scores. You can get the score that I pulled. It says it for each bureau. You click on a button and it says your mortgage score is 740. Now, that doesn't mean that I'm going to pull exactly a 740, but I'm going to pull a 741 or a 739 or something really, really close to it, okay? Depends on when that person pulled their mortgage score and then when I do it. But this to me, I mean, you've got your borrowers here are spending hundreds of thousands of dollars on something that you're selling them, and it's very important that they understand the whole process here. And credit score is, of course, one of the big 3 qualifying factors. So it's great to use this if you think someone's got an issue. Even if they don't, that's fine.
Jody, before you, remember you're not leaving credit yet, but a couple of questions. If they have a credit score of 640 or lower, does that mean no loan? No loan for you?
So not necessarily. 620 is really the bottom of it that will go. There are lenders that go in the 500s, but that's really tough to do. For us, we're going to look at the actual profile and see why, you know, if you've got a 620, why do you have a 620? Is it because of late payments? Is it because of a collection? Or are you just maxed out on your cards? Or maybe you don't have enough credit history. So I'll take a look at that as well. Even if it's something we know is not going to work for a few months, I'm still happy to take a look at someone's credit report and kind of help guide them. I'm not a credit counselor and I'm not a reporting bureau, so I have to be really careful of that, but I can tell them this to me looks like what your issue is. So it's a case-by-case basis, Mike.
Can you say something about soft and hard inquiry, how long the credit score is affected? And I'll add to that, what about the buyer who says, I don't want to get pre-approved until I find the house I want to buy because the credit pull is going to hurt my credit and then I won't be able to buy the house I want.
Yeah, this is extremely common. It's almost on every conversation I have when we get to that stage where I talk about needing to pull credit. People do not want their credit pulled multiple times because of that. The scores, when I pull your credit, it's going to go down 3, 4, maybe 5 points. After about 120 days, though, it bounces right back up. That is just part of the process, and I just have to try my best to convince the borrowers that there's no way around this. There's no lender that's going to pre-approve you without looking at your credit. And I've had people ask me that to do it. That they tell me what their score is, but I don't do it because it's not the right thing to do. You're setting people up for failure. So, you know, that's a conversation that I'll have with the borrower. You don't need to worry about that as an agent. People don't like it, but the hard inquiry will pull the score down. If any of you have been on any of my other calls talking about the process, this is why I've mentioned before, it's best to only get your pre-approval done with one lender. Now, hold on. because you're probably saying, wait, that's really risky. What if you end up not being able to do it? It is, but here's the thing. I'm gonna know really right away if there's any issue with credit, income, assets from what the borrower, the documentation they give me. Of course, there's always room that things could go south, but for the most part, if it's a loan that I can do and I get a DU approval, desktop underwriting approval, then we're pretty solid. At that point, the borrower can call around and shop different rates, different companies, but they don't have to have their credit pulled for it. And if a lender says, I'm not going to give you a rate quote without pulling credit, then just move on. You don't want to work with them because that's not fair. It's not fair to the consumer. I can give a rate quote, tell me what your score is in the scenario, and I can give you a rate quote in 2 minutes, and I'm happy to do it, okay? So anyway, that's the soft pull, if that's what you'd asked about, is kind of like what companies pull to tell you you're pre-approved for a credit score. I'm sorry, a credit card or a personal loan or something. They're doing a high level pull of your credit that doesn't really result in an inquiry. It just tells them if there's any public information reported, bankruptcies, foreclosures, collections, judgments, that kind of thing, and they can see a general score. So you might see, like with your own credit card company, they may send you a letter and say, hey, congratulations, based on your history, we've increased your credit limit, or based on your history, we've decreased your credit limit. It's because they're doing soft pulls. They're going in there and taking a look at your account or your profile every so often to ensure that you're not about to be on the verge of bankruptcy, right? They want to make sure that you haven't all of a sudden missed payments and racking up more credit card debt just to turn around and file Chapter 7 or something. So that's the difference between a hard inquiry and soft inquiries. Soft inquiries do not affect credit score at all.
All right, and then can we still buy furniture if we pay by credit card during the loan process?
The potential downside to that is if we do have to end up for whatever reason pulling a full report and that monthly payment has gone up, then we will have to include that in debt to income ratio. So it's risky. I mean, it's not super common to pull a full report right before closing, but I'll give you a scenario and where we would have to is, let's say January 1st, I pre-approve a borrower. The credit report's good for 120 days. Then I have to pull hard inquiry, brand new report. We're not closing till May 15th. That's 5.5 months. I'm going to have to pull a new report. So typically, I'm still going to say, please don't do anything that could potentially adversely affect this process. The last thing you want is for someone to not be able to buy their house because they spent $10,000 at the furniture shop with a $1,000 a month payment, and their debt to income ratio is now 55%. So that would be my answer to that.
All right, you have to do cash, as long as it doesn't deplete your reserves. And I'll leave it. I'll back. That's it.
Yeah, I mean, they can pay cash, but again, if that digs into their assets, if we're kind of tight on assets, it's just not a good thing to do. I really think it's not a good idea to shop like that when you're about to buy a property. It's just not. It's too risky. Too many things could go wrong from it.
Is it a good idea to pay off debt before you get qualified?
If you have enough assets to do that, yeah, sure. It's going to increase your credit score, but definitely do not close any accounts. If you close, let's say you pay off your Amex, $10,000, you pay it off and you close it, that reduces your available credit and that's going to reduce your credit score. So you can definitely pay off debt if you want. Again, I'm happy to look at your report. If you want to send me a Credit Karma report or something like that, I'm happy to look at it and kind of give you a little bit of guidance. But you can definitely do that if you'd like.
And what's your maximum debt to income ratio?
50%. And those come with a few things that's needed, a certain FICO score, a certain loan to value, that kind of thing. Just, again, lenders really have to focus a lot on responsible lending. And back in the day, it wasn't like that. So that's even doing a 50%, if I've had that before, but I always want to make sure that, first of all, the borrower's comfortable with that payment, because 50% of your income going to housing it's quite a bit, but we can do it.
How about your maximum loan amount?
We actually don't have a maximum loan amount. One of my colleagues just closed a $7 million purchase last month, so we don't have a maximum loan amount. Anything over 3 million, our management has to approve, but as long as it meets guidelines, they do.
All right. That's it for now.
Okay. All right. Okay. Oh, okay. Which product is best? So this is just a little blurb here about what we have at Golden One. We have an 80-10-10 product that is for jumbo loans up to, let's see, where's my screen there? 1.5 million. Oh, the maximum loan, first loan is, I'm sorry, I'm just reading this here real quick, aggregate. Okay, so it would be like 1.25 with a maximum second mortgage of 250,000. So basically, you've got a buyer and they want to buy a house for $1.5 million, but they have only 150,000 to put down, 10%. We can do that. We give them a 10% second mortgage and then an 80% first mortgage, and that avoids mortgage insurance. The first mortgage is also priced as if their combined loan to value was 80%. So they're getting credit on their rate as if they're putting 20% down, but they're really not. They're only putting 10% down. It's a very popular product that we have, and it's used quite a bit. Anytime you can open a home equity line of credit at the time of purchase, that's the best time to do it. You actually can utilize part of your equity that way, 10% of your equity after closing. So let's say you've got a buyer at 1.5 million, they've got $500,000 in assets, so they can put down 20%, no problem. They may still choose to do a 10% down loan with a 10% second, just to have that second mortgage. After closing, they can pay it off, and then for 15 years, they've got available credit of $250,000, or I'm sorry, for that scenario, it'd be $150,000. And then, you know, I actually have this going on right now, and the guy, he's got plenty of money, but he's going to utilize this so that then he's got the $150,000 line of credit, and he can start using that to do some work around the house, some renovations, new kitchen, that kind of thing. The benefit to it as well is that in the future, if you ever wanted to refinance your loan and maybe put them all in the same loan together, it's still considered a rate and term refinance, which carries a better interest rate than cash out. So let's say you don't open up the second at time of purchase, you open up a second mortgage 2 years later, and then you want to refinance maybe 3 years later, combine those two, it's going to be cash out, and you're going to have 8, maybe a quarter higher rate because of that. So anytime you can do it, it's a good idea. Here you've got, this is for jumbo, by the way, the little box down here that is our guidelines right now. And this is subject to change. So if you ever, have a question or you want to confirm that this is still going on, let me know. I don't anticipate this changing at all. Things did change a lot last year just because of COVID, and lenders were kind of shuffling around, how do we work with this? People still want to buy a house, but maybe, they got laid off or something like that, or getting unemployment. But we have gone back now to our pre-COVID guidelines. And I'm really happy about these. I mean, 700 minimum FICO with a loan amount of 1.5 is pretty awesome. Going to see a little bit of a hit to the interest rate for it, maybe a quarter or so, but it's still a great offering that we have. The 95% loan to value up to $1 million. What I like about that is if you guys follow any of this stuff like from Fannie Mae guidelines that change every year, Fannie Mae did change their conforming high balance loan amount from $726,500 last year to $822,235 this year, which means that now I have to price a loan up to that loan amount as conforming high balance. Those rates are 1/4 to 3/8 higher right now. we can get a jumbo loan pricing, it's always going to be better. I locked one yesterday at 2.875, 850 loan amount. Doing a first and second, okay?
We may have a question, just a second.
Okay.
Does Golden Bond work with first-time homebuyer grants or other loans that help first-time homebuyers?
So the quick and short of is not really, because in our area here, or not me, because our area here, typically the income to qualify to buy something in the Bay Area is higher than what the down payment grant association will allow. So it's kind of like it's there, but you can't really use it because you don't qualify for it. There are some loans like FHA and Fannie Mae do not allow grants at all. But it's a good question. I get it all the time, you know, first time home buyer grants, but those really haven't been around since, gosh, I want to say 2011, 12-ish, when, if you guys recall, there was like a $7,500 tax credit that the government was giving for first-time home buyers. That was great, except the next year everybody found out they were getting taxed on that money. So, you know, I would say most likely no.
All right, and then what's an 80-10-10?
Oh, perfect. Okay, so 80-10-10. 80 plus 10 plus 10 equals 100, right? So for simple math, let's go with $1 million purchase price. The 80% is the $800,000 loan. Well, you know, I say that, and here I am remembering again that Fannie Mae increased their loan amount for conforming high balance. So we have to have, to be able to use this product, we have to have a minimum first loan amount at $822,235. So let's just remember that, okay? But typically it's 80% first mortgage, a 10% second mortgage, and then the borrower puts down the other 10%.
Sorry.
These used to be super, there were 80-20 loans back in the mid 2000s where people were putting down nothing. You know, I mean, of course, that's part of what caused the crash, because people didn't have any skin in the game, so they didn't have anything to lose by walking away from their property. So we brought some of that back, but with a minimum down payment of 10%.
And just to remind everybody that I will be sending everyone a copy of the handouts afterwards. We're being asked that. And one person would like to ask a question, but I'm having difficulty. All right, let's go. Go ahead.
All right. Gift funds, if you can look 1, 2, 3, 4 down, 100% gift funds on our conforming and high balance products. Not everybody allows that. Place I just left, it was 5% of your own funds, but here we do 100%. We do FHA, conventional portfolio lending. Portfolio lending is basically where we fund a loan and keep that on our books. We don't sell it to Fannie Mae or FHA. And a lot of lenders do that. There are investors that do buy, you know, jumbo, they invest in jumbo mortgages, but we don't really go with them that much because the guidelines are pretty crazy and weird, and there's so many different ones out there that we just say we're going to portfolio these, keep them on our books. Typically, people don't keep a loan for 30 years. It's just not really something that happens. But in any event, we do portfolio them. Let's see, 97% LTV. So that's your Fannie Mae 3% down, up to conforming high balance loan limit, which would be 822, 234 envelope is 3% down with mortgage insurance. Okay, definitely going to have mortgage insurance if you've got a loan to value or combined, not combined, but loan to value over 80%. There's going to be mortgage insurance. That's something that I can actually do a quick calculator and tell the borrower what it would be. Then they can decide, do I want to pay mortgage insurance or do I want to put 20% down? One of the benefits to, and this is not true for FHA, but for conventional conforming or conforming high balance, is the mortgage insurance eventually does drop off. It either follows the amortization schedule, So let's say, you know, the borrower at year 8 is going to be at the 80% loan to value, the mortgage insurance will completely drop off, then it has to by law. Or let's say a year from now, maybe somebody got a big bonus and they want to pay their mortgage down. They can pay it down to the 80% and then mortgage insurance is dropped. Or they can say, I think I've got more value now, 6 months from now, 6 months from closing. They pay for a new appraisal and then we see that it is, and then mortgage insurance is dropped. So it's not something that's for forever. All right, step 2. I feel like we went through all the steps already.
Can you hear me?
Yes, I can hear you.
Thanks, Michael. This is great. I have some questions. You know, I can't put them in the group text. So can I ask some of these questions if you don't mind?
Speak.
Sure.
Awesome. ITN numbers. Are you doing ITN numbers? ITN?
No.
Okay.
No, I'm sorry.
Yeah. If you have this is for a refinance question, EDD. If the client's on wife's working, but the husband's on EDD, can you still refi?
I'm sorry, DDD or?
Unemployment.
We can't
Because
use
of the COVID.
Yeah,
because of the COVID, they're on unemployment.
Yeah, I know, but we still can't use it. I don't know any lenders that are able to use unemployment income.
Okay.
There is one potential scenario you could get away with it, but I'd have to really deep dive into their situation. It has to do with the type of employment, and I actually have never seen someone that has basically seasonal employment. But if they're seasonally employed and they have been for several years and they're getting a little bit of unemployment in between the seasons, then we can potentially use that. But for the most part,
Thank you.
it's not allowed.
Perfect. No, that's great. Thank you. And then medical bills, does that count towards debt to income?
I don't believe so. I mean, it's not really
you have
a credit.
a couple of,
Yeah. Unless it's reflecting on their credit report, then we're probably not going to really get into that. We don't, based on HIPAA, we don't get into really any medical issues. Even if someone has a medical collection, we are not allowed to talk about it. It might still hurt their credit, but we don't get into it. We don't ask for explanations. We don't do anything about it.
And then if they had a Verizon bill or a T-Mobile bill and they haven't paid it for, 3 years, and it's like $120 left, do they contact their credit bureau to take that off? Will that?
You mean are you saying that there's $150 balance and they haven't paid it, or they have paid it and it's still showing that it's active?
Yes. They haven't paid it. It's been on there for 3 years. It's been on their credit as they need to pay it. About $120 for an example. Do they go ahead and just?
If it's something they owe, they're going to need to pay it, because what's going to happen with that, and what I see is each time a collection account, because I'm assuming it's at collections at that point, is sold to a new company, and collection companies do it all the time, it's re-reported. So probably not going to be able to run away from it, to be quite frank. So they just need to pay it and move on. That would be my suggestion.
And if they pay it, you said rapid rescore. So rapid rescore is no longer. I thought that was still able to. You were able to still rapid rescore.
I don't believe we can do that. I'll double check. I mean, maybe something changed in the guidelines and I didn't get wind of it. But what I suggest is once they pay it off, well, first of all, if it's a collection, you call the collection company and do whatever you need to do with them, settle, negotiate, whatever. Get a letter from them saying that they'll accept a certain amount, pay that amount, and then typically that collection is going to come off their credit report. It might show as a collection, but as long as it shows paid and the zero balance, we're good to go.
Oh, perfect. Yeah, thank you so much. I appreciate it. And I'd like to talk to you on a after this if that's if they leave a number. If you leave a number.
Oh yeah, definitely.
I've texted the number to everybody. If you look in the chat.
Oh, awesome. Thank you, Michael.
All right, thank you.
Okay, so I know we're almost at an hour here, so I'll kind of breeze through some of this. This is the part right here that's the most stressful for everybody involved. So you got a contract executed, buyer seller agree, you give it to me. That's the time that I talk with the borrower about locking the interest rate. That's the time that they can actually call other lenders and get quotes if they want. Any day before they have a contract, and this does happen, this is a separate call I do, it doesn't matter what the interest rate is at all. It's not something they can lock. It's going to change most likely. So you can't really lock the loan until you have the contract. The rate lock follows the property address, not the borrower. So anyway, so let's assume we've got the contract here and we've locked the loan. Now the next step is disclosures. So basically, I'll take everything, input the property address and everything into the system, purchase price, down payment, price it out, get it locked. Then I send it over to my disclosure team and they prepare the upfront disclosures. Everything is now going to electronic signature, sorry. So our disclosures are just electronically sent. There's one form that has to be printed and wet signed, and that's the Social Security Administration form. The Social Security Administration currently does not accept any type of electronic signatures. So in the event we have to confirm that someone's Social Security number is correct, then that's the only form they would print and sign. Everything else is done electronically. Once they sign the full file, both borrowers separately, okay, each one will have their own login. That's for us considered the intent to proceed, and that's when I can order the appraisal. In those disclosures, you will see the loan estimate, or they will see the loan estimate, a bunch of federal and state disclosures. A lot of it, same stuff they're going to sign at closing, kind of redundant, but it's what's required. Once I order the appraisal, which I can do immediately upon the email that I get that they've signed their disclosures, and I get that right away. We order the appraisal. If one is needed, make it an appraisal waiver. If the person, even on a purchase, got really great credit, high credit score, 30% down, something like that, you have a chance. I did one last year, $2.2 million loan amount, no appraisal needed. I was shocked, but we didn't have to have one. Anyway, how long did they take? Typically about 10 days, but we are seeing a little bit of a delay right now just because of demand. This has come up here for me past couple of transactions here. But we did add another vendor. Now we have 4 vendors that we work with. As you all know, lenders do not employ their own appraisers. They're not allowed to, they don't do it. It's all third party. So we have vendors that we work with. For example, there's one called SWBC. We place an order with SWBC. They send that appraisal order out to their appraisers in the area. An appraiser says, hey, I'll take that order, but maybe I want $750 for it. Then we have to go back to the borrower and say, this is what they're asking. Will you approve this increase in fee? Maybe it's a bigger house, then they want more money because it's going to take longer to do. In that case, then we say yes, go ahead, and then the appraiser contacts the listing agent. If the property's vacant, as a listing agent, don't be surprised if they don't call you. They'll go online and see if it's vacant on Lockbox, and they're going to go over there whenever they want to and do the appraisal, so you may not even know. For example, 1,000 square foot single family residence, probably going to be around $650. A 2,500 square foot duplex, $1,300 because it's more involved, it's more complex. Okay, so underwriting. This is one of the fun parts. So once I have all of the documentation, which I normally have up front, and then I've got the contract, we've got the appraisal ordered, then the loan goes immediately for us. It goes immediately to underwriting. It doesn't go to a processor. It goes straight to underwriting queue. That usually is about 24 to 48 hours turn time. Underwriter will review everything in the file and issue either a conditional approval or they may suspend the loan. If there's an issue with credit, income, assets that maybe I didn't uncover or that came up after the fact, then the loan is suspended for about 7 days, and that's the time I have to work directly with the borrower to resolve any issues that might come up, or say, you know, maybe it's just not going to work out, and then we know that, and then unfortunately we wouldn't be able to proceed. But typically we're conditionally approved. We may even conditionally approve a loan. Maybe the borrower is getting a bonus in 2 weeks, and we know they're getting it, but they don't have it in their account now to use for down payment. So we'll conditionally approve the loan, but one of the conditions will be receipt of that money. There could be more conditions added at this stage, and I'm just going to be frank with you guys. Conditions can be added at any time during the process. Even if you got your conditional approval, underwriting may come back and say, hey, you know, this tax return shows this type of income. We need to document this further. So I'm going to go back to the borrowers and request more documentation. I know that people get really, you know, upset when they feel like we keep coming after them and after them and after them, but conditions may require more conditions. It's just the nature of the beast. Again, we're having to make sure and fully document that we're lending responsibly, and it does require digging deep into people's financial situations. It's not anything personal, but it is something that we have to do. So help me, help you, to help our mutual client understand that this is not anything that's bad. It's just, it's something that we have to, you know, figure out here. Let's see, something that could be a condition on a condition is deposits. Let's say, you know, we've got the bank statements and then earnest money has cleared. Now I need a transaction history. All right, you give me a transaction history, but now we see that you've got, you know, 2 large deposits before your earnest money cleared. Where did this money come from? Either you'll get, I don't want to tell you, or, oh, that was, you know, from whatever it was from. I sold a car or something, I don't know, whatever it could be. So then we have to source those funds, because remember, we can't have borrowed funds in a real estate transaction. So that's really all we're doing, is confirming that the funds aren't borrowed and they're not coming from an illegal source, okay, such as money laundering and that kind of thing. So digging deep into this, to the borrower's documents, but that's just what we have to do. Okay, so get the conditional approval, then I'll work directly with the borrowers. I'm gonna know if I get a bank statement, there's large deposits, I'm gonna go ahead and source that right away. I'm not gonna wait for underwriting to do it, because I know they're going to ask for these things. But once we have, okay, conditional approval, I'll work with the borrower, get all the documents in. Oh, there's the appraisal, it's in at contract price, it's as is, meaning there's no repairs needed. Then we go back to underwriting for final approval. That's when the underwriter looks at all the conditions we've turned in and either says loan is final approved, or hey, we see this now on this, based on this document that the borrower turned in between the first underwrite and now, and we do need a couple of extra pieces of documentation to clarify something. So there's potential for that to happen. Not really super common, but it does happen. So we just have to address it, just jump right on it, get it in, get it done. And then final approval is usually issued within about 24 hours of submission. So it will go pretty quick. I'm not gonna read all of this to you guys. I know you can read it yourself. So when you have time, take a peek at it. And then if you have questions, feel free to let me know. I've got here some examples of things that can come up at this stage in the game where we're just about ready for final approval. Tax returns, transcripts executed. Every lender requires the 4506T to be signed. You're not going to find a lender that doesn't. And every lender reserves the right to execute that 4506T. So let's say you're self-employed and we've got your loan in. We haven't executed the 4506T, but we've got a scenario now. Maybe you gave us 2 different tax returns for the same year. Which happened? One you qualify, one you don't. What's going on here? We're going to now find out from the IRS which tax return you filed. Okay, we execute the 4506T, great. You file the ones with IRS that you qualify, perfect. We'll move on with that. Tell us why you gave us the other one, and then we'll go forward. If you execute the 4506T, it has to be for 2 years, even if the 1 year is what you're trying to verify. This particular scenario, the person hadn't even filed 2018s, so we couldn't close the loan, all right? That stunk. It was really disappointing, but was really out of our control. So that's why I go back to that. Please make sure your tax returns are filed. It's super important. Federal tax liens take precedence over mortgage liens. So worst case scenario, you've got, $200,000 back taxes. We close you, and then all of a sudden the government slapped a federal tax lien on your property and on yourself. What's the best thing for you to do at this point? Maybe you put 10% down. Maybe you put $100,000 down. You could just walk away from it. And then what's going to happen is the federal government, the IRS, will be paid the $200,000 out of proceeds, if there are proceeds, before we are paid. So it's very important to make sure that there's no federal tax issues. If you do owe taxes, so maybe you're making payments for the last 3 years taxes, and you owe $50,000. As long as you're on a payment plan, that's cool with us. Just send us what the payment plan is. We'll pop that into your debt to income ratio. We do not require you to have all of those taxes paid before closing. Telling us you're on a payment plan tells us that you're responsible, you're taking care of your business, and most likely not going to have a federal tax lien put on you or the property. I have only one time in however many years I've been doing this, had someone who right before closing, we called to verify employment. It happens on every loan, and the person quit their job the day before. No employment. They hadn't even started a new job, so we couldn't close that loan. But for the most part, that doesn't really happen. If the earnest money or down payment can't be verified, probably going to have an issue, or maybe we have to go with a lower down payment and maybe use only the funds that we have verified. Let's see. Okay, we already talked about opening new credit. All right, where are we at next? Here, closing. The fun part. Once we have final approval, our loans go straight to the closing team, and that happens within sometimes the same day. If it's a final approved end of the day, it'll go the next morning or next early afternoon. I didn't mention this, but previously, once the loan's conditionally approved, we have the appraisal, the home insurance, we can send out the closing disclosure. Starts at 3-day wait. So we don't wait till right before. Okay, so my closer will work with the closing team over at the title company to balance the closing disclosure, make sure all the numbers are right. And then once we have that final CD and it's approved and it's balanced between Golden One and the title company, then we send out our closing package. That's sent electronically. I'm copied on it. I have access to it. I can send the full closing package to the borrower before closing. They want to read through, it's 97 pages, want to read through it, go ahead and answer any questions they have. I'm happy to do that. I don't get that request a lot, but I do get it. At that point, with the balanced CD, I tell the borrower, I usually tell them when they get the initial CD, but sometimes things can change. But that's when the borrower will initiate their wire to the title company. Title company provides the wiring instructions. All that is the account number, routing number that the funds have to go to. We send the closing package. That's when the closing date, time, location's scheduled, whatever's convenient for all parties, except me. I don't physically go to it with COVID, but I'm happy to do that once everything starts getting lifted. Once the borrower signs, if it's at their house, the notary drives the package back to title. Title faxes us all the documents that the borrower signed. We review, make sure no signatures were missed or there's no corrections needed. Pending everything looks good, then we say you're authorized to fund. We approve the funding. Title records. Title disperses all of the money in the transaction, and then the keys are given to the new homeowners once they're showing on record. And there you go. Then you have you've been a part of someone's exciting time in their life where they're spending the most money on a single object than they ever will, and it's always an honor for me to be a part of that transaction. So it's exciting. So if you guys ever need me, I hope that you'll consider giving me a call. I say this to everybody, and I mean it. My cell number is there for you to use. Call, text, email, whatever. If you have a question, I don't ever want you to go to bed worried, even as the agent, okay? Maybe you're stressed out about something. Call me, and if it's a question I can answer and relieve your stress, then I'm happy to do that. Don't wait till the next morning, okay, and then not sleep. I've been in the shoes before. I've bought a couple of houses, so I know, even me doing this, I know how stressful it can be. So I'm always available evenings and weekends to you guys. So here's where I would open up the Q&A. I know we're getting past an hour. I'm fine to sit here all day and talk. So Mike, I'm turning it back over to you now, and we can.
Yeah, just a few. So you left out the best part of closing.
Oh, where the agents get their commission checks?
Yes, yeah, that may be more important than the buyer getting the keys. So question, do you do VA loans?
I'm sorry, say that again.
VA loans.
VA, no, not yet. We are working on that. We were supposed to get it last year, but then COVID hit and we stopped that process, but it's back in the works now. So in the next few months, if not, hopefully by the end of this year, we'll be able to do VA. We do FHA though.
Right. And Monica says you're the best. So
Monica, thank you. I enjoy working with her. She's very sweet, understanding, and on top of her game. So appreciate that.
when should a buyer remove the loan contingency? When they have a conditional or final approval?
Typically, you're going to do that when you got your conditional approval, but that's a good time for us to have the conversation right before you release your finance contingency to make sure, because I'm going to see all the conditions. I know what the underwriter is looking for. And when you give me those items, I'm going to review that. So typically that's the time you would do it. But you always have to know that anything can go south during time after that. It does stink. I know it's not ideal, but a conditional approval is not final, and you never get final approval until the very end. Literally the scenario I gave you guys earlier about the person that had not filed the 2018 returns, and we had a weird thing about the 2019s, that happened after conditional approval, and she didn't get the house. You got her earnest money back though, but that's something I didn't anticipate, but
yeah,
that would be my answer.
It ain't over till it's over. I had a transaction once where the lender took the money out of escrow because they had found out that the company that the buyer worked for was laying people off. They re-verified employment. He was on the list to be laid off. They took the money out. That's about as close as I've ever been to, and not having close. So you don't, until it ain't over till it's over. Is it right? There's a question about, is it recommended to have the listing agent check with the buyer's lender to know the loan status? I would say yes to that as a coach of people. If you're the listing agent, you ought to call whoever wrote the pre-approval letter to see that they've even heard of the buyer and know anything about it.
Correct. And I'm happy to take that phone call. That does happen more often than not.
It should, right? Especially if you're being competitive. How does one proceed if they have a cash transferred from a foreign bank to an American bank?
We allow that, actually.
Oh, this one says, and don't need financing. That's a different question. It doesn't necessarily, the lender doesn't care. If the borrowers have unpaid, to pay it right, that's correct. Do you have to prove the money source even if it's seasoned?
No.
No. And I'm going to answer, Richard is asking if you do mobile home loans, and the answer is no, right?
No. The manufactured housing, yes, but the caveat to that is you have to own the property that the home is on. So you can't have leased land.
Right. So usually, for those of you that need a mobile home lender, you'll notice that a lot of listing agents will put names and phone numbers of mobile home lenders in the MLS so they don't get calls from agents with pre-approvals from like Golden One, because most of the lenders that you can name off the top of your head do not do mobile home loans. And they're very different. It's like 6% interest. It's not the same kind of loan. All right. Yeah. That's, I think, a wrap.
Okay.
All right. Sorry, I jumped in there and answered some of your questions.
Cool. Well,
right, I have texted several times Jody's contact information. If you've got a live one, give her a call, reach out to her. And anything you want to say in parting, Jody? Well,
no, I appreciate everyone's time, and I look forward to hearing from you. And I'm always here. So don't hesitate to reach out to me.
Send those loans. All right. Have a great day, everybody.
Have a great day. Happy Good Friday. Thank you.
Thank you.